Well, hello, everyone, and welcome to another episode of the Lending Podcast. We are your hosts. That's Jeff
Hello.
Jones, and I'm John Burnham. Thank you for being with us again today. We have an interesting topic for you because not a lot of folks know about this program. And so we'd love to share it with you.
Yeah, I love it. So it's called the MCC. Yeah, you know
MCC.
me. Mortgage Credit Certificate. So we are Texas lenders. We're based here in Austin, and we love this program. It went away for a short time. It is back with certain paradigms involved in it, and we want to talk you through how it affects people that are looking at buying a home right now.
That's right. And so the MCC program, in short, is an IRS tax credit. At the
Mhm.
end of the year, when you file your taxes, your 1040 with the IRS, you will be eligible for a certain percentage of the
Mhm.
interest that you paid to come back to you as a refund. And so right now, it's about 15% of the total interest that you pay on an annual basis. And that's going to come back when you file your IRS tax return as a refund. So there's a couple things that we can do here and a couple strategies that you can look at and use as a buyer. And there's some fine print. Let's just get into that real quick. Who qualifies, why would you want to do it, all those things. And so what we love about it is that it really can reduce the overall amount that you pay on an annual basis, right? Or a monthly basis if you want to factor it, take that number and divide by 12. And for a lot of our first time buyers, this is really key because affordability is such a key component right now to this market. And we're seeing a lot of folks that are maybe concerned about what their payment's going to be. This is a strategy to help reduce your overall outlay on an annual basis.
Yeah. So what is MCC, the Mortgage Credit Certificate? I like how you laid it out. I like the fact that people are thinking, wait, interest on my mortgage. So as you look at your amortization payment schedule on a mortgage, say it's a 30-year fixed, we'll have a piece of paper that will lay out every monthly payment, how much is principal, how much is interest. And then, of course, you have taxes and insurance.
Right.
But the principal interest, that interest piece gets accumulated for the whole year of how much interest you paid that year on your mortgage.
Mm-hmm.
Your lender will provide you a statement every year for your taxes of how much mortgage insurance you paid for that year. So this 15% is basically like a credit. So of that year's mortgage interest. So just to lay that out, on an amortization table, the majority of your first, second, third, up to years, oh gosh, I don't want to get in trouble, but on an amortization table, it's going to be more than half of your term. You're paying more interest than you are toward principal, right? So, and then of course, as you get to the end of the life of the loan, you're paying more principal than interest. So the tables turn. But that's a lot of interest being paid every month.
It
And
is.
so to get some of that back, to get 15% of that back, is huge.
It's a big number, and we ran some numbers. So let's set the stage a little bit. So who is this program designed for? This program is designed for first time buyers who are looking for down payment assistance as well.
Mm-hmm.
And even if you have your own down payment saved up, we're going to talk about an example here in a minute where I had a client that has their own down payment. They were ready to put their own money down. They ran the numbers on this program and it made more sense to take the down payment assistance money
Nice.
and use the MCC credit
Yeah.
to reduce their overall outlay. So, who is this designed for? So, we used a $300,000 price point. It's good up to, well, there's not really a loan limit. It used to be a little over 400,000. I believe that's increased to some degree now, but it's an income limit. So there are some income limits, and I believe it's somewhere in the 110 to $120,000 a year range. There are some. This is annual qualifying income. There are some targeted areas where that
Yeah.
income might be a little higher. So specific to your situation, we're going to dive into that.
Yeah, and for those that are listening, you're like, well, what is my income limit? There is a website you can go to, and it's a
Mm-hmm.
4-question quiz,
That's right.
super easy to use. If you just Google T-Shack,
Mm-hmm. It's
so
Texas State Affordable Housing Corporation.
yep. So
So
if you're in
TSHAC.
yeah, so if you're in Texas, go to that site. You can click on those 4 questions. It'll ask you your occupation because they do have occupation specific assistance.
Mm-hmm.
It'll ask you as well your annual income and what county you're in, and how many dependents. So what that does is that gives a grid, it puts you into a grid to see what eligibility you are.
That's true. Yeah. I
So
think I just gave the wrong website. tsahc.org.
.org.
I flipped the A and the H.
It's a nonprofit.
That's right. It is a 501c3
Mhm.
nonprofit here in Texas.
Yeah.
And there are a couple of different programs. We're highlighting that one today. So in this example,
So $300,000 purchase. I
yeah.
like it.
So let's talk about the numbers real
Mhm.
quick. So the $300,000 purchase price. Okay, this program is good with FHA loans.
Mhm.
It is good with conventional loans. It does also work with VA. There's reasons that you would and would not want to use it with VA, and it's good with USDA. So primarily, we see it with conventional. We see it with FHA.
Yeah.
The other two are used more seldom, because those are 100% financing options.
Right.
USDA and VA, you don't really need down payment assistance because it's a 100% loan, but there are reasons that you might want to do it. Conventional is a 3% down loan typically. FHA is a 3.5% down loan typically. So how the TSHAC program works is you can get down payment assistance of 2% up to 5%. So 2%, 3%, 4, or 5. Okay. The higher the down payment assistance, the higher the interest rate.
Right, because they're forking over money.
That's right. They're giving you this down payment. Now, you must keep this loan for 3 years.
3 years.
If you take the down payment assistance. So you can sell the property, you can refinance. However, if you do within 36 months, you'll have to pay the down payment assistance back. Okay. So this is a $300,000 scenario.
Yeah. And there's no proration on that. So if you sell your house on month 35, you owe the whole down payment assistance back.
That's
if you
right.
sell your house on month 36 and a half, you don't owe anything back.
That's right. That's right. So you
really
need to have a good feel for if you're going to live in the house for 3 years or not. And
but
again,
sometimes that still makes sense.
For sure. And so we ran this at a $300K purchase price with a 7.5% rate, which as of the time we're filming this is the interest rate for the 3% down MCC credit program. Okay. That is an annual interest payment of roughly $22,500. You would be eligible for a refund back from the IRS of 15% of that number, which is roughly $3,400.
Yeah,
right?
$33.75.
$33.75. So $3,375 coming back to you as a refund. Now, here's what's cool. There's two strategies here. I get excited about this because you can wait till April 15th every year to file your taxes. Or another strategy that some of our clients use is they change their withholding with their employer. So you can have your employer take out $300 less dollars a month, $280 less per month. You could actually receive that as extra income on a monthly basis and still have the same zero tax liability in April when you file.
$281 a month.
More. So truly income to you. You can take it on a monthly basis, or you can wait, file your taxes, take it on an annual basis.
Which is fun because when we start originating these, and this is the right program for you, we go through the whole scenario of like pros, cons. We like it. What we do on our file is we actualize that 281 a month into your debt to income ratio, which gives you more buying power.
That's right. Yeah, and 281, it does. It's huge. And that amount of money, just quick math, is about the equivalent of $30,000 to $40,000 in purchase price. Yeah. So if you're qualified at $275,000, you could get to a 3 or 310 purchase price qualification number with this MCC calculation because it is truly realized income that you're getting on an annual basis. So pretty cool strategy.
Okay.
So
I like that. That was good.
Yeah. So let me give you a quick example of a recent client. We actually have this client under contract right now. Touched on this a second ago. She has saved a lot of money. This is a first-time buyer. She has a really good job. She's been very frugal with her and very strategic with her savings and responsible. And she is sitting on about 50 grand in the bank in her savings account right now. So we ran the numbers for her. And she said, I want to see what this looks like if I keep my own money working for me, and I take the down payment assistance and I take the MCC credit over the next 3 years. What does that look like versus putting my own down payment down?
Smart.
And the numbers it actually blew me away. It made more sense for her to take the down payment assistance, with the MCC credit, leave her money in her brokerage account, assuming an 8 to 10% rate of return on her money, which is pretty fair. And she knew she's going to be in the house for more than 3 years, or expected that she will be. And it made more sense for her to take this program.
Man, that makes my heart warm.
Right?
So, yes, there are many lenders are only looking at your loan transaction. What I love is what you're talking about is a holistic financial picture of our clients. And a lot of times we do also work with financial planners with our clients. But the fact that, the calculation included keeping your cash, getting the down payment assistance instead of using your cash on hand, and investing that into something that's going to make you money, and using that as part of the calculation, right? Of like, what's my net worth you know, at the end of a year or 3 years under this program? What's my net worth under 3 years at this other program? And that's a big deal.
It is. It's fun to run those numbers, and
Mm-hmm.
also have a client who's open minded to looking at that. It doesn't work on every scenario.
Right.
Sometimes it's way better to go ahead and take the down payment assistance, or to go ahead and put your own down payment down, than to take the DPA.
Mm-hmm.
In this example, she has an incredibly high credit score, over 800. She's doing a
Nice.
conventional loan, and her overall cost of her mortgage with her scenario just made more sense to do this. There are other times where it might not work out that way, but let us guide you through that. Let's
Yeah.
run the numbers, assess it. I always say I'll let the numbers do the talking, right? Let the math make the decision. Let's
Mm-hmm.
not prejudge what we think we want or need, and let's let the math make the decision.
Right.
And so in her scenario, that's how it worked out. So it's pretty cool. We're excited this program is back, because it was out for about a year or so, and we didn't have access to the MCC. A lot of our clients are looking at this now, and realizing that, okay, this could
Mm-hmm.
make sense for them.
Yeah, I think the timing of it is interesting that it's back. So it used to even have like a standalone version where when you're buying your home, you might be able to get the mortgage credit certificate. You take the quiz and you pass, and then you can take a home buyer course and qualify for it. But now it is only paired with the down payment assistance programs.
That's right.
So that's how it is currently here in Texas. That might change down the road. So it's always good to touch base with your lender about, where is the mortgage credit certificate? Am I eligible for it? What program does that look like? Because that does evolve over time. Qualifications for the program are updated every year. The program adjusts rates every day. So there are a lot of moving factors. It is very nuanced. So it's always good to talk to a professional about it.
Yeah,
And
and
yeah,
there's some benefits too for some of our first responders out there,
right.
firefighters, police, even our teachers as well. There are this program in conjunction with this called Home for Heroes
Home for
that
Heroes.
will give you some additional financial benefit if you fit into a certain employment category, that will reduce the cost for this. We didn't really talk about the cost. It costs $700 one time, so this is a $700 cost on the high side to save $3,400 a year. So that's a no brainer.
Right.
You're basically, it pays for itself in 3 months,
Yeah.
right? So, but some of our first responders and other professions under the Home for Heroes, that fee is waived.
Right.
So that's another benefit. So it's a really, really cool program. We're excited that it's back. Again, it doesn't fit for everybody. However, we'd love to see if it fits for you, and we'd love to guide you through this, and navigate the numbers.
Yeah. So if you're a realtor out there and you have borrowers that are struggling to get to the price point they're hoping to get to, have them talk to a lender about the mortgage credit certificate, see if that could increase their buying power. If you are listening to this and you're looking at buying a home, contact us directly, and we'd love to walk you through what that could look like for you. But thank you so much for always listening to the Lending Podcast with JB and myself. We're here for you here in Austin, Texas. And please like, subscribe, and share.
Thanks for being with us. We'll see you again soon.